What on earth is the Federal Reserve doing? For months, the Fed has been trying publicly to convince us that the economy in the US is strong. And Federal Reserve Chairman Jerome Powell recently unequivocally stated that, quote unquote, the Federal Reserve is not currently forecasting a recession. But the Fed's actions tell a completely different story. If the US economy really is performing well, any economics textbook will tell you that the Fed should not be reducing interest rates. Interest rate cuts should be saved for times when the economy is in serious trouble. Using up all your ammunition before a downturn has begun is simply foolish. Yet the Federal Reserve continues to insist that the financial system is functioning normally. But meanwhile, things are spinning so wildly out of control that they felt forced to announce overnight repurchase agreements operations for Tuesday, Wednesday, and Thursday, and now all of this week. We haven't seen this sort of emergency intervention since the last financial crisis, but the Fed's message to the general public is that all is well. Unfortunately, the truth is that all is not well. And we continue to get more troubling economic news with each passing day. In a desperate attempt to inject some vigour back into the US economy, the Fed cut interest rates for the second month in a row last Wednesday. For the second time in 2 months, the Federal Reserve on Wednesday agreed to press down on the economy's accelerator to keep the 10-year-old expansion chugging along. A divided Fed lowered its benchmark interest rate by another 0.25 percentage point to a range of 1 3/4 to 2% in an effort to stave off a possible recession triggered by a global economic slowdown and the US trade war with China. Of course, this wasn't enough to please President Trump, and shortly after the rate cut was announced, he posted the following on Twitter, quote, Jay Powell and the Federal Reserve fail again. No guts, no sense, no vision. A terrible communicator. End of quote. Apparently, Trump wanted an even larger rate cut with the promise of more rate cuts in the future. But if the US economy really is in good shape, we shouldn't be having any rate cuts at all. This was a panic move by the Fed, and they're going to find themselves very short on ammunition when things really start to get crazy. Also, conducting overnight repurchase agreement operations for 3 days in a row, let alone all this week, also reeks of desperation. If you're not familiar with the repo market, which, by the way, I put on an email as a video for you all this last weekend. So if you haven't had a chance to look at it, I suggest you do. It's by Richard Wolff, who is a very clear and easy person to understand. And he speaks very slowly and clearly. So I strongly recommend that you watch it. Anyway, if you're not familiar with the repo market, this is how Yahoo News described the key role it plays for the financial system. Quote, financial institutions use money markets to borrow for very short periods from 1 day to a year, a crucial function to keep the gears of the economy running. In so-called repurchase or repo agreements, banks borrow by putting up assets like treasury notes as collateral and then repay the loans with interest the following day. End of quote. In a fit of panic, the Fed injected $53 billion into the system on Tuesday and another $75 billion on Wednesday. But it turns out that Wednesday's injection wasn't nearly large enough. The following comes from Zero Hedge, quote, 20 minutes after today's repo operation began, it concluded, and there was some bad news in it. As we feared, yesterday's take-up of the Fed's repo operation, which peaked at $53.2 billion, has expanded substantially, and, according to the Fed, today there was a whopping $80.05 billion in bids submitted, an increase of $27 billion or 50% more than yesterday. It also meant that since the operation, which is capped at $75 billion, was oversubscribed by over $5 billion, that there were one or more participants who did not get up to $5 billion in the critical liquidity they needed, and that the Fed will see a chorus of demands by everyone because, like with the discount window, nobody will dare to be singled out either to expand the size of its operations, implement a fixed operation, and or, most likely, as per the ICAP noted yesterday, transition to permanent open market operations, i.e. QE, or quantitative easing. End of quote. Then we learnt that the Fed had announced that they were going to inject another $75 billion on Thursday. Ladies and gentlemen, this is utter insanity, and to many it is clear evidence that the Fed is losing control. Quoting Michael Schumacher, Director, Rate Strategy at Wells Fargo, "This just doesn't look good. You set your target, you're the all-powerful Fed, you're supposed to control it, and you can't on Fed Day. It looks bad. This has been a tough run for Powell." End of quote. We haven't seen anything like this since the financial crisis of 2008, and many are deeply concerned about what will happen as liquidity demands reach a peak as we approach the end of the month. As the financial system continues to become increasingly unstable, is this sort of Fed intervention going to become a regular thing? Of course, there are some analysts already projecting that a massive new round of quantitative easing is inevitable at this point, and there is a very good chance that they are right. Meanwhile, the real economy continues to deteriorate as well, with one new survey finding that a majority of US CFOs now expect the economy to tumble into a new recession by the end of next year. Chief financial officers in the United States have started to prepare themselves and their finances for a recession. For the first time in several years, economic uncertainty is now their lead concern, replacing worries about the difficulty of hiring and retaining talented workers. According to CNN, 53% of chief financial officers expect the United States to enter a recession before the 2020 presidential election. That information was sourced from the Duke University CFO Global Business Outlook survey released on Wednesday. 2/3 predict a downturn by the end of next year. We may not have to wait that long, and according to John Williams of shadowstats.com, if honest numbers were being used, they would show that the US economy is already in a recession right now. For the moment, most Americans are still buying the narrative that everything is going to be just fine. But that will soon change. The pace at which things are deteriorating is beginning to accelerate, and the Fed is going to have to hit the panic button many more times in the months ahead.